Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, markets looking to extend a record run. The NASDAQ and S&P 500 closing at new all-time highs again as investors wait on a widely expected rate cut from the Federal Reserve. U.S. stock futures pointing to a higher open, more gains. This after the latest reading on retail sales grew more than expected in August. Sales rising 0.6% last month, likely driven by back-to-school shopping, but the Dow looks like it is indicating a little bit of a lower open in contrast with the other two averages. Plus, the focus on Wall Street squarely on the Federal Reserve. The central bank kicking off its two-day policy meeting with newly confirmed board governor Stephen Miran. The Senate voting last night to put him on the board, largely along party lines in a 48-47 vote. Also at the table in this week's meeting, Federal Reserve Governor Lisa Cook. A federal appeals court ruling against President Trump in his bid to fire her before the meeting. And closing in on a deal for TikTok. Treasury Secretary Bessent saying this morning that President Trump was ready to let the social media platform go dark in the U.S., and that motivated China to reach an agreement. This follows his comments yesterday that President Trump will finalize the deal in a call with Chinese President Xi Jinping on Friday. Shares of Oracle are extending gains as the company will be reportedly one of those involved in the deal. Let's get a check in on stock futures here this morning. As we mentioned, we are seeing the Dow a little bit under pressure here this morning, indicating a slightly lower open, but the NASDAQ and the S&P indicating an extension of their record closes once again yesterday. Let's talk about what's behind some of the movement here today and dig into our top stories of the day. The Fed's two-day meeting kicking off in Washington with both Stephen Miran and Lisa Cook on the Board of Governors. August retail sales topping expectations despite concerns that the U.S. consumer is tapped out, and markets closed at yet another record, with Bank of America's latest fund manager survey showing the most bullish sentiment since February. Joining me here this morning, we've got our Alley Canal at the NASDAQ, Fed correspondent Jennifer Schonberger, and senior reporter Brooke DePalma joining me here this morning. So a lot to consider here this morning. Jennifer, I actually want to start with you here. We talked about a little suspense yesterday over who would actually be in the Fed meeting beginning now, and now we know who's going to be in that room.
Yeah, Julie, the Fed kicking off their two-day policy meeting with a full FOMC. Stephen Miran, President Trump's nominee to replace former Fed Governor Adriana Kugler, confirmed by the Senate last night along a close party line vote, 48-47. He is expected to be sworn in time to participate in the policy meeting. And Fed Governor Lisa Cook will also be participating. Last night, a federal appeals court rejected an emergency request by the president to remove Cook from the board. The White House expected to appeal this to the Supreme Court, telling me in a statement this morning, quote, "The president lawfully removed Lisa Cook for cause. The administration will appeal this decision and looks forward to ultimate victory on the issue." As for the data at hand, the market's widely expecting a 25 basis point rate cut. Of course, the bigger question is, how many more rate cuts could we see for the rest of this year? Could it be one more rate cut, which would be a total of 2 rate cuts, which would match what projections were back in June? Or could we see more cuts penciled in? And of course, that is going to hinge on how officials perceive weakness in the labor market juxtaposed with inflation.
Yes, most definitely. And that's where a lot of the focus is going to be on that press conference, trying to parse through Powell's comments to see what's going to happen next here. So the backdrop for all of this is that stocks are at a record, Allie, right? So, and it feels like there is a lot of bullishness out there. At least that's what was in evidence in Bank of America's latest fund manager survey.
Yeah, the most bullish survey that we've seen since February. We saw equity allocations back at 7-month highs. There's a lot of optimism around global growth, the expectation of Fed easing. Those surveyed expect 4 rate cuts over the next 12 months, but still cash balances are now at 3.9%. So this is below the 4% threshold that Bank of America flags. And it's often seen as a contrarian sell signal because investors essentially have less dry powder to buy dips. That raises concerns over crowding in the market, and historically that flashes caution when sentiment runs a bit too hot. But in other words, managers are clearly all in on the risk here. At the same time, this bullish backdrop comes with some contradictions. So a record 58% of respondents now say stocks are overvalued. Long Magnificent Seven continues to be the most crowded trade at a time when we've been talking about the need for more broadening of this rally. And a second wave of inflation tops those second half of the year tail risks. In fact, 77% of those surveyed expect stagflation. That is an economic scenario where growth stagnates, unemployment rises, and inflation remains hot. So even though fund managers are leaning in to this soft landing narrative, how Fed easing is going to offset some of those macro risks, the market does remain vulnerable, especially if the economy turns. But what we saw this morning with retail sales, the consumer still seems to be holding up here, Julie.
Yeah, let's dig into those retail sales a little bit. Brooke, I know that you've been watching those, and they did come in a little better than estimated.
Yeah, some of my sources that I've spoken with over the past few days really have showed that the consumer has been resilient. And it seems like we've heard that word on every single earnings call over this past quarter. And we saw those numbers prove that strength in August. We saw the total retail sales increase 0.6% month over month. That was higher than what the street had expected. And if you take out motor vehicles and parts, we also saw that number increase about 0.7% compared to an estimate of an increase of 0.4%. And what I found most interesting within this report is if you dive in, it really signals that the back-to-school holiday shopping trends were strong, despite this pessimism or fear on the street, and that there wouldn't be much strength, that maybe consumers wouldn't spend as much. But what we saw over month to month is that clothing and clothing accessories really did drive strength over the month of August. We did see that category increase about 1%. And then non-store retailers, so think about companies like Amazon that ships directly to the house, we did see that increase about 2%. And of course, there was so many promotions, particularly in July, but certainly in August as well, as consumers really sought out convenience and promotion and deals and best value during that month. Essentially, back to school did well, and that's what we saw. It beat expectations for the month.
And Brooke, there's also some new data out on who is spending, right? Who is accounting for the consumer spending that's happening that's really interesting.
Yeah, Moody's put out a report this morning saying that customers within the top 10% of the income distribution accounted for 49.2% of total spending in the second quarter. And as you can see here, we've steadily seen the high income consumer really contribute more and more to this economy. And there's some fear on the street that should that consumer essentially pull back ever so slightly, especially if their investments within the market go down, then they won't have as much discretionary income that's really been boosting the momentum within this economy right now. And we've heard this from different companies, in particular from Dollar General and Dollar Tree. Both of those discount retailers really touted that their newer consumer makes up, or rather the high income consumer makes up a majority of their new customers. Also, Walmart continues to gain high income shoppers. And so while this is great for the economy right now, there is that backdrop of fear that this consumer will pull back.
Right, and that also feeds into the Fed and everything else that we've been talking about here this morning. Allie, Jennifer, Brooke, thank you. Coming up, we'll have more on the record rally in stocks and take a look at some of today's top trending tickers. That's next on Morning Brief. Now time for some of today's trending tickers. We are watching the New York Times, Warner Brothers, and Webtoons. First up, the New York Times. The stock is dropping as President Donald Trump files a $15 billion defamation and libel lawsuit against the newspaper. In the suit, Trump criticized the Times' endorsement of former presidential candidate Kamala Harris in the 2024 election. He said the paper's front page included a line that said it is hard to imagine a candidate more unworthy than him for the presidency. Trump is accusing the paper of a decades-long method of lying about him. The amount he's seeking exceeds the market capitalization of the New York Times, which currently stands at about $9.6 billion. Next up, Warner Brothers Discovery shares taking a hit as TD Cowen downgrades the stock to hold from buy. The analyst changing the rating as Warner Brothers surged on optimism of a potential bid from Paramount Skydance. He says the stock surge is well beyond the firm's $14 price target. While he does see a potential bid at $20 a share, the risk reward is too high. If the bid were to fall through, he sees shares hitting $11 to $12. And finally, Webtoon, Disney announcing it plans to acquire a 2% equity stake in the company. The investment's part of a deepening partnership between the two. Webtoon, known for its massive catalog of comics, it also has animated series from its stories. As part of the partnership, Disney will provide 35,000 comics to the digital platform through a single subscription. The comics range from Marvel to Star Wars and other Disney originals, those shares surging 32%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, stocks closed at records Monday with the S&P 500 above 6,600, with the Fed expected to kick off a cutting cycle at its policy meeting. My next guest says market volatility could return. That's not necessarily something investors should be afraid of. Jonathan Curtis, Franklin Equity Group CIO, is joining us now in the studio. Thanks for being here.
Thank you for having me.
So we've seen this sort of inexorable rise now in stocks. Some have called it a melt up, whatever you want to call it. It has meant records and records and records.
Yep.
Does something change once we actually get that Fed rate cut?
Yeah, I think what we will end up getting is a little more volatility. We'll have a sort of a sell the news event. And then investors will be betting and trying to determine how many rate cuts to go. But as active investors, we love environments like that because that creates opportunities for us. We are thinking very long term about what lies ahead. We think that this rate cutting cycle will give impetus to a new business cycle. But then most importantly, what lies ahead is enormous opportunity around this AI opportunity, both in the build and experimentation phase, but then subsequently in the application phase. And I think that's going to drive growth both fundamentally and in the markets for many years to come.
Well, just to take one example, I mean, yesterday we saw Alphabet reach a record high, $3 trillion market cap. Isn't that AI opportunity pretty well appreciated by the market at this point with the run-up that we've seen in a lot of those stocks?
Yeah, we don't think so. We estimate that knowledge workers in aggregate create about $50 trillion of economic value annually. I started my career as a software developer. I'm an engineer by training. These models are incredible at writing software. If you listen to the world's largest tech companies, they're getting almost as much as 30 to 40% of the code they are writing out of these models now. So if you can make a software developer 20, 30, 40% more productive, imagine what you can do with a knowledge worker. So you take that $50 trillion TAM for knowledge worker value add, and you make a knowledge worker 10% more productive, that's $5 trillion of economic value that can come out of these models just in knowledge workers. That doesn't get at anything with new scientific discoveries, that doesn't get at physical AI, so we think the market is still remarkably cheap. So a lot of opportunity lies ahead.
So I have a lot of follow-up questions if that is the thesis. Firstly, yes, it might make those individuals that much more valuable, but it also probably will mean that fewer people need to be hired overall to do that work. So what then happens to the sort of consumer demand cycle if fewer people maybe have jobs or are less lucrative jobs, for example?
Well, we are definitely entering a period of change. Technology has always driven disruption. There are no more lamplighters, there are no more people making straps for horse and buggies, so the world changes. And what people are going to need to do is evolve with that change. I think what's going to happen, though, is that the grunt work of knowledge work, that will go down. The value of that will go down. We will rely on these models to help us with that. And human beings will do what human beings are good at, evaluating other human beings, engaging with other human beings, leaning into the high value stuff that only a human being will ever be able to do. So there will be change and there will be disruption, but I think the human beings that learn how to use these models and then lean into their humanity, I think are going to do very, very well.
And I guess the other thing I would ask is timeline, which is always very tricky to figure out. but is important if you're figuring out an investment horizon and opportunity. So how do you think about that?
Yeah, these exponentials in these models are incredible. They are improving at a pace faster than Moore's Law. If you remember, Moore's Law was sort of the rules of tech for the past 60 years. Every 18 months to 2 years, chips would get half as expensive and 2 times as powerful, so 4 times improvement. These models are improving at a pace faster than that. So to really lay out the timeline is incredibly hard, but I know it is going to go much faster than it did in the past 60 years. And ultimately through that, as long-term investors, we're trying to figure out what the terminal value is. But I think investors should be prepared to be surprised to the upside here over the next few years, not to the downside.
And where, right? Because I know that there's been a lot of debate. Software, for example, some sectors of software have been hit because the view is they'll be superseded perhaps by AI. You have the hyperscalers. So where do you see the most opportunity?
Yeah, well, first off, let's break this down into the build and experimentation phase and then the application phase. I think investors understand that there's an enormous opportunity around build and experimentation. They're starting to price in the revenue opportunity for the hyperscalers, for the tech companies, for the gas-fired turbine companies, even natural gas companies. What they are missing right now for the build and experimentation companies is that they will also be the first appliers of AI into their business. We've seen this already with Meta a little bit, how efficient they're being able to get at creating interesting ads or keeping their costs under control. We're seeing the same thing with Microsoft. They took out 9,000 people out of their cost structure and are still growing at high or mid-teens growth rate, and their cloud business is accelerating. So you can go to the big tech companies and see opportunity there. But now let's go into the S&P 493. Those companies are going to be the appliers of artificial intelligence. So then what are the most knowledge worker intensive parts of the S&P 493? It's in financial services and it's in healthcare. What's so powerful about those two sectors are they are both loaded with knowledge workers, they are loaded with data, and they are loaded with reward functions that can be trained on. We work in the financial services industry. We can check a thesis, a logic of thesis, and then see what happens to the stock price over time. So that's reward data that can be trained on. So we think the two big areas that are not being priced, actually 3 big areas that are not being priced correctly: the efficiency gains for the big tech companies and the efficiency gains in the S&P 493, in particular in healthcare and in financial services.
Interesting. All right, the last question, I want to kind of like go in a different direction a little bit because we're asking almost everyone this. The president thinks that we should change the reporting timeline for companies, right? As somebody who is evaluating corporations' equities all the time to try and figure out, as you said, you're an active investor. You want information, presumably. But on what cadence do you want that information? Would it hurt your ability to make investment decisions if companies were reporting earnings twice a year instead of 4 times a year?
Yeah, listen, I started my career on Wall Street as a sell-side analyst. Then I moved over to the buy side. Earnings season is very, very difficult and very, very valuable. So it allows us to check in on our thesis. So on our side of the table, regular reporting is quite valuable. On the other side of the table, it's actually a massive distraction. The companies we ask them to think long term, and then we measure them on a quarterly shot clock. And so I see some logic, some value in moving to a 6-month time horizon, because I think it will allow our management teams, our companies, to think longer term. As an investor, we would lose something. We would lose that ability to regularly check in, but I think we would get it back in longer term thinking, higher quality businesses.
And what, just to quickly follow up on that, what about the sort of gamification, if you will, of it? In other words, 75% of companies beat earnings per share estimates every single time. Is the sell side just really bad at estimating? Is it just like a game that everybody knows they're playing? Like, how do you fix for that?
It's a game that everybody knows they're playing. And so the logic of moving to a longer time horizon will take down that gameplay, and I think allow management teams to focus on what they should be focused on, allocating capital to the highest returns, as opposed to playing the game of trying to outsmart Wall Street.
Interesting. Well, we'll see if that's what happens. Jonathan, thank you so much.
Thank you.
Coming up on Yahoo Finance Opening Bid, our executive editor, Brian Sazzi, joins us now. Saz, I know this is a topic that is also near and dear to your heart.
Julie, do you like quarterly earnings?
I mean, it gives us a lot to talk about. I'll say, I'm talking my book here.
It does. If you really think about that, who in the world created earnings estimates? I mean, it's something cooked up by Wall Street to make extra trading profits. Nonetheless, we'll continue to dive into all things quarterly earnings. We're going to talk to Octus co-founder and CEO Todd McKinnon about their AI push. I'm even going to ask him what he thinks about quarterly earnings. When you're a CEO of a public company, it feels like every single day you're preparing for the next earnings release, Julie.
That's how it feels like. Earnings season never ends. That's what it feels like.
Does it end?
All right, that does it for Morning Brief. Thanks, Saz. Looking forward to opening bid. Keep it right here.